Today, we're diving into Disney Plus, which is set to launch on Tuesday, November 12th. So either if you're listening to this, depending on when you're listening to this, it's either about to come out or it's already come out. And then at the end, we're going to kind of take a look at who might win the streaming wars down the line. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zax.com. Also, make sure to subscribe and leave a review wherever you listen to your podcast. So right off the bat, I'm going to jump into a little bit of Disney's recent quarterly earnings results, but we're not going to get too much into that. We're going to do mostly Disney Plus and streaming stuff today. But Disney did report its Q4 and full year fiscal 2019 financial results last Thursday, November 7th. The company topped our quarterly earnings estimates, but it did mark a roughly 28% decline from the year ago period as it continues to spend heavily on its streaming future, which we'll get into, as I said. Meanwhile, Q4 revenues were up 34%, with full year sales up 17% to about $70 billion. And we should note that 34% growth is pretty big, and that's including these last two quarters have included Disney's Fox deal and its full control over Hulu, so that's why those numbers are a little inflated for the revenue year-over-year climbs, because Q3 was up 33%, but we should note that the quarter before that, Q2 of 2019, was up only 3%, and Q1 actually saw a marginal dip. So the last two quarters have been very strong, driven by, as I mentioned, that big Fox deal, which they made to help boost their streaming future. And we should note that shares of Disney climbed about 4% on Friday on the back of those top and bottom line beats. And we should note that its super variable studio entertainment division was up 52%, once again driven by Fox. But also, this is an interesting division because it's always on a quarter over quarter or year over year basis, very up and down because of just the basic premise of how box office schedules and hits and misses work. So this past quarter, it was The Lion King remake and Toy Story 4 and Aladdin all competing against the year ago period, which had just Incredibles 2 and Ant-Man and the Wasp. So that's why it's up really big. So that was the standout of all four of their divisions, but we're not going to talk any more about their actual quarter results, because now their outlook and all of Wall Street and investors are really just wanting to know what Disney streaming future is going to look like. So as we mentioned at the outset, Disney Plus is set to officially launch on Tuesday, November 12th. CEO Bob Iger and Disney have been preparing for this streaming future, which is going to be a big part of the business from now on, unless some dramatic shift happens that we can't anticipate. And some might argue that Disney's acquisition of Marvel back in 2009, and Lucasfilms, which is, just think of it as Star Wars, in 2012, were part of this anticipated jump into streaming. But even if they weren't thinking that far ahead, its $71 billion deal to acquire key 21st Century Fox assets and its 2017 purchase of BAM Tech is set to really play a massive role in its streaming TV future. So we should note, for those of you who haven't heard of this company before, BAM Tech is a technology company that helped create Major League Baseball streaming service back in the day, and also helped HBO Now and other streaming services. And they bought it for what now looks like to be a pretty big steal at the time, as their back end over-the-top streaming tech company, which is crucial to ESPN Plus and Disney Plus going forward. In a recent Wall Street Journal story that was talking about Disney's streaming future, this is just to put things into context, a media executive was quoted as saying that Disney's BAM Tech deal is, quote, is probably the best acquisition by any traditional media company ever. So that's maybe overstated for some, but that just gives you some context of how important this BAM Tech deal is going to be to Disney's future. So now we're going to dive into some more of the details and what people can expect from Disney Plus. So the service will cost $6.99 per month, so $7 a month, or $70 for the year. So you'd save about 2 months worth of month over monthly purchases. And this is going to grant users access to old and new content from its namesake Disney brand, Pixar, Marvel, Star Wars, National Geographic, and much more. And then we should also note that Disney Plus is going to be bundled along with ESPN Plus and ad-supported Hulu for $13 a month. And this could prove to be one of the more enticing offers in all of this streaming entertainment and really just entertainment in general going forward. And I think that that's part of the reason why Disney long-term looks to be in a really solid position in this streaming TV world. So at launch, Disney Plus is going to offer 10 original movies / specials and new original series that are going to be exclusive to Disney Plus. And this is including its much hyped Star Wars original series that's called The Mandalorian. And Disney is reportedly spending an estimated $2.5 billion on its streaming TV exclusive content now, and going to add to that figure going forward. And this is a little bit of details. It's kind of a lot of numbers to throw at you at once, but it's just to give you a sense of the scope of what Disney Plus is going to try to roll out now and over the next several years. So on their conference call last week, CEO Bob Iger noted that at launch, Disney Plus users will have immediate access to more than 500 movies, and then including our beloved titles, and more than 7,500 episodes of library television content. This is including 30 seasons of The Simpsons. And then by year 5, they're expecting this will grow from 500 movies to 620 movies and more than 10,000 episodes of television, along with what they're calling shorts and other features as well. And so within a year of launch in terms of original content, the amount of original content on Disney Plus will increase from more than 45 series, specials, and movies to about 60 new original programming and projects by 5 years from now. And this is going to be, they're going to try to roll out 60 new things every year, to 60 per year. So that's a pretty strong number in terms of original content that's going to be exclusive to just this Disney Plus platform. And on top of that, we should note that starting in March, Hulu, which Disney owns, will become the exclusive and official streaming home of FX networks, which is kind of, you could say, one of the more edgy channels on basic cable that you're not having to pay special to get, unlike HBO. So that's home to shows such as Always Sunny in Philadelphia, American Horror Story, and much more. So this is really, Hulu is going forward is going to be where a lot of Disney's more adult-focused content, which they are getting mostly from their big Fox deal, is going to live, where they're not going to have shows like American Horror Story living on Disney Plus. They want that to be more of that their family-focused business, where the most kind of adult-focused thing would be something like Star Wars or those Marvel movies that are rated PG-13. And then on top of Disney Plus and Hulu, ESPN Plus, which launched all the way back, which now seems like forever ago, in April of 2018, is a $5 per month, $50 a year, pared down standalone version of its ESPN service, which is their, as most people know at this point, their big sports network. They now have over 3.5 million paid users on just this $4.99 a month ESPN Plus service. And for reference, that is not just a standalone version of ESPN. It's just the streaming version. We likely won't get a standalone version of that big ESPN with all of their college sports and NBA basketball and Monday Night Football and all of that for some time, because a lot of those deals are wrapped up on the basis of it being on live TV, and these cable companies have incentive to continue to keep users there, and live sports is really one of the last reasons why a lot of cord cutters or people who might cut the cord are choosing not to, because live sports are harder to reach. So instead, ESPN Plus has focused on faster growing sports that are geared, you could say, more towards young people. This includes, they've spent a bunch of money on UFC rights, which has helped the platform grow hugely recently. This also includes some domestic soccer and international soccer rights, different college sports, not the major high-end college basketball and college football, which is still hugely important to the actual ESPN. But it's a service that clearly is going to be worth $5 a month to a lot of people who care about something like the UFC or international soccer or something like that, or something as off the path as volleyball, which is also available on ESPN Plus and different lower, not as talked about college sports. So overall, Disney looks to be in a strong place going forward. And we should note that if you're looking to buy Disney Plus, which is obviously a key for the company going forward, that people can easily access it, it's going to be available on, quote, a growing variety of partners, platforms including Apple, Google, Microsoft, Sony, Roku. And CEO Bob Iger was also noted specifically on the earnings call that they are pleased to announce distribution partnerships with Amazon Fire, Samsung, and LG. Specifically Amazon Fire, because if you read some reports leading up to it, people were worried that you were not going to be able to get Disney Plus on Amazon Fire TVs, which would have been a big deal because they're the second largest streaming player in terms of where you can access all these different services, behind only Roku. So they had about 30% of the US market in terms of that streaming media players in the second quarter of this year. So it's a big deal that they got that Amazon deal ironed out. In Disney's plan long-term, as we mentioned, they're spending a lot of money, and based on this price point of $6.99, $7 a month, they're really trying to grab users right away in this crowded streaming market and plan on making money farther down the road. So they have that super attractive price point, and they don't even expect to break even on their streaming business until 2024. But we should also note that in terms of the rollout, it's going to be just in the US on November 12th, and then North America. And within 2 years, they expect it to be worldwide, and it's going to make its way to most of Western Europe by March 31st of 2020. And now I want to take a broader look at what's going on in this overall streaming market before we kind of dive into, I think, who might be the longer-term winners of this streaming war, if you want to call it that. So Netflix is still by far the largest streaming TV company in the world. It closed Q3, which was its most recent quarter, with just over 158 million paid subscribers around the world. But we should note that it fell short of its own subscriber figures in back-to-back quarters, so that's Q2 and Q3. The last couple times it had fallen short of quarterly estimates, which actually happened a lot in the second quarter, it would bounce back with a huge beat, often over 1 million above its own estimates after it fell short. And this time, after falling well short in Q2, it also fell short in Q3. So that could start some people getting more nervous that maybe its growth is topping out, especially as its U.S. market becomes more and more saturated. So most of us know a lot about Netflix. It's offering prices. Its most popular is $12.99, so far above what Disney Plus is offering. We should also note this is going to include Apple TV Plus, which launched on November 1st, right ahead of Disney. That launched at $5 a month. Doesn't have much content out there yet, only about 9 shows and no library content to attract users. So that $4.99 is really just to kind of get people to say, hey, why not take a chance on one of these couple shows that they've pushed out. This includes a show about news networks, C, which is a post-apocalyptic show, and a show called For All Mankind, which is a fictional space race era show. I am going to get Apple TV Plus because I have one of the newer iPhones, and so anyone who bought a new iPhone or some other qualifying devices gets a year of Apple TV Plus for free. And this is kind of Apple's long-term thing. They don't need this streaming TV service to be a hit. Their business is iPhones and all these other services, so they just want people to have some incentive to maybe watch some of these shows, and down the line, if Apple TV Plus works out, it's just a bonus, but they certainly don't need it for their device or for their business. And they're really just trying to get as many different services in the hands of their roughly 1 billion users around the world who use one of their devices. And then on top of Apple TV Plus and Netflix, we also have HBO Max coming to the fold. And this is going to be in May of 2020. And you can think of HBO Max as kind of HBO on steroids. That's going to include a lot of Warner Media offerings, which includes Friends. It's going to cost $15 a month, which is actually $1 less than Netflix high-end plan that includes 4 screens. And they're going to target about 90 million subscribers by the end of 2025. Which would be far less still than Netflix at the moment, but shows you where HBO thinks they're going to compete. And HBO really started this whole premium cable business years ago, and I can't imagine that HBO Max, which is actually going to come in at the same price as HBO Now, isn't going to be an attractive service for people, since people are already paying just for HBO, and now you're going to have a lot of other movies and TV shows that are through that Warner Media division, which is part of AT&T, which AT&T bought. Now it has HBO as well. And we should also note that along with HBO Max, we have Peacock, which is set to launch in April of 2020. And Peacock is going to be NBC Universal's branded streaming service, NBC Universal, owned by Comcast. They're going to have some original shows, but they're also going to be home to some really rewatchable shows, which are The Office and Parks and Rec, Cheers, Everyone Loves Raymond. So that's where we're going to have to see what this streaming world looks like, because at the moment, Netflix relies very heavily in terms of those shows such as The Office and Parks and Rec, which are going to be leaving. So that library content of that kind of binge-worthy, you can watch 5 episodes of these 22-minute comedies over and over and over again. That actually is about 70% of Netflix total viewing hours based on Nielsen data. So it's going to be interesting to watch what Netflix is able to do. In long term, it's going to have to prove that its own original content is going to be worth its price points. And that's really what this whole conversation comes down to, is who do you think has the content to have people decide they're going to pay whatever X price point is per month. And it seems like Netflix obviously has a big head start, and people aren't just going to dump Netflix. But some of its shows are obviously hits, but it's a big reason why they spent over $500 million for the streaming rights to Seinfeld, because they know that they also need shows that have a massive library of content already where people can binge it. And so it'll just be interesting to watch that going forward. And then one of the other ones that doesn't really get talked about as much, I guess you could say, certainly in my opinion, is Amazon Prime Video. That costs $9 per month if you just want that Prime Video, but it's also included for free for anyone who pays that yearly Amazon Prime membership, which is geared, as most people know, towards that retail in those shipping deals. So Amazon, similar to Apple, sees their video, which they've been in for much longer than Apple. Apple's just starting. Amazon's been doing video for years. They see it kind of as a win-win for them. If they're able to attract people to this Amazon Prime Video, it'll be a win in the long run, but they don't need this business to succeed, whereas Netflix whole business is streaming video. And their shows have actually been pretty successful, and they're going to roll out even more new shows, and Jeff Bezos' company is willing to spend a lot of money on content going forward. So Amazon Prime Video is definitely one to watch out, especially when you consider that they've also have some live sports rights. This includes some Premier League soccer rights in the UK and also Thursday Night Football. They share those. They have the streaming rights to Thursday Night Football here in the States that Fox has those rights to on Thursday Night Football. So in terms of these streaming content players, the only 2 companies at the moment that offer people the chance to have all that on-demand streaming content and live sports are Amazon and Disney, which is part of the reason why I think those 2 long-term might be in the best position to win this quote unquote streaming war. But all of these companies it seems like they'll be able to survive as more and more people cut the cord. But I want to end with a little bit of some poll results from a Wall Street Journal and Harris poll that came out just over the weekend in terms of what people are thinking of as they decide whether or not or what services to subscribe to in this more crowded streaming space. So we should note that Americans this is based on this Wall Street Journal and Harris poll, Americans are going to be willing to spend an average of $44 a month on streaming video and subscribe to an average of 3.6 services. And this is based on that survey once again. What I found interesting is that supposedly, or based on the survey, that nearly 1 in 3 current Netflix subscribers said they will likely cancel the service in the next 3 months to make room for one of these new entrants. And obviously this is just based on what they said they're likely to do, so who knows if this will actually be the case. But if 1 in 3 people, especially in the US, just decide they're going to cut Netflix just to try out one of these other services, that could be devastating to Netflix business. Obviously, that's not a guarantee that'll happen, but it's certainly something I haven't heard until this poll of that 1 in 3 people could decide just to unsubscribe from Netflix. And obviously, for anyone who doesn't know, you can cut these services off at any time. That's kind of the part of the reason they're attractive. You sign up for HBO for a couple months, you watch Game of Thrones, you get rid of it, do the same thing with Netflix and any of these services. So down the line, that might change as less and less people are actually subscribing to cable, so you have nowhere else to go. So you're just going to continue to bounce around all these services, or are you going to just decide you're going to stay on them for the long haul? And then, so overall, it seems like the business is going to be booming for all of these companies that decide to jump into this streaming world. But as I mentioned, I think Disney Plus really does have a long-term, they look like they could be maybe the long-term winner of this whole space, just based on their brands and their ability to just get people to sign up on those brands alone. Pixar, Disney, Marvel, Star Wars, National Geographic, The Simpsons, Avatar, all of these Fox properties they're going to own. Just the ability to offer a bundled package of ESPN Plus, Hulu, Disney Plus. Really, if you're going to only be able to subscribe to one service, it seems kind of like a no-brainer that would be maybe the one streaming service you subscribe to, when you think that Netflix is soon going to lose a lot of its library content, and it's offering just its service alone for that same price point as you could get all 3 of those services that Disney's offering. And obviously Amazon looks to be in a good position long term as well. In HBO Max, HBO has kind of invented the space, and they will clearly be a player for a long time. But overall, I mentioned that I think Disney and Amazon will be the longer term winners. In Netflix could be in a maybe more, I don't want to say dire situation, but they could be in bigger trouble sooner than some people might expect, based on the success of these other new services like Apple and Disney Plus, and how well their shows are received. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.